Everyone's worried about an AI bubble forming, but Google stock just did something the rest of big tech didn't. Alphabet jumped nearly 6% to a record high after Berkshire Hathaway bought almost 18 million shares. A rare move for a company that almost never touches Silicon Valley. It's basically a value investing stamp of approval. Google trades at lower multiples than Nvidia and Microsoft. Its AI tools are gaining traction, and Google Cloud is finally becoming a real growth engine. So today, we're looking at what this Berkshire move really means and whether Google stock still makes sense at these levels. Welcome to another video. My name is Robin, and as per usual, I'm joined by Kirill. And today we're gonna jump into a company that we haven't really discussed in quite some time, Kirill. We're gonna talk about Google, or importantly, of course, the Google stock analysis. And we will go over our three main subjects of every video that we do. We're gonna do what's in the news. We're gonna go over the fundamentals of Google, and finally, the value that you're gonna get out of this video is the valuation of Google stock. But guys, remember, this is not financial advice. This is only for entertainment and for educational purposes only. Kirill, what's in the news?
Well, Robin, it's very interesting news, I would say, because you said it absolutely correct. Alphabet got into the pocket of Berkshire Hathaway, miraculously, actually, because I fully agree with you. It's quite a rare move when Berkshire is actually putting quite a big bet on the FANG stock, and especially on the tech stock. Of course, we had quite some exposure of Apple for quite a while, even though now it's getting trimmed down, and now Alphabet is getting there, and it's and the stake is big, as you also accurately said. We're talking about 4.9 billion worth of investment, which happened in the previous quarter. That's the only thing to keep in mind. So if we go and look into what has actually happened in terms of the trades of Warren Buffett, you can also see it in this lovely table from Dataroma. Not, unfortunately, a product placement or any marketing. Maybe at some point, if Dataroma would like to sponsor us, please let us know. Would be really happy. But anyways, great product. So you can see that they've trimmed down some Apple quite considerably, 15%, and they got into Apple and Chubb, which we were also thinking to film about, and some Domino's Pizza. I think these were the major, at least, purchases. So what we were thinking about, since this purchase has been made in the Q3, and now, especially on the news today, the stock went up quite significantly. I think about 5% at the opening, and then it got down to, I think, 3-4% at this very moment while we're filming. So now again, of course, the question is, after half a year since we looked into Google, is it a good buy? Is it worth it at the moment, or maybe the hype train is kind of already departed, and it's already quite expensive to get on it? Yeah,
exactly. And I think there's only one way to find out. So, Kirill, let's jump straight ahead into the fundamentals of Google.
Yes, sir. With pleasure. So first of all, we can see the 930 score of B, which is actually quite nice, and it's mainly driven by the healthy performance on the margins and the growth, especially on the net income growth, and it's still quite all right on the revenue growth and the free cash flow growth, according to our 930 score. However, you can see that it has been lagging behind on the P ratio and the stock price. So it means that it's actually quite a good opportunity. So the stock is performing very well, but it's not being really appreciated by the stock market for whatever reason. So probably that's one of the reasons why it's probably not Warren Buffett who actually made that call. I can imagine it's probably some of his upcoming, let's say, new CEO, and maybe the other lieutenants in his team probably made the decision, because they're gradually taking over from him. So it actually makes sense. It makes a lot of sense, especially for also looking into the maybe some time before that, when there was a slight dip in the stock. So it totally makes sense. Fully agree with it. No more, no less. So
Nice. Well, that's good, crew. I think your next flight should be to Omaha. Get in there, buddy.
yes, put it in the
Uh,
chopper.
but yeah, let's see what kind of numbers they have. So we see a gross margin of almost 60%. That is really insane. Operating margin of 33%. What else? A PE ratio that's actually acceptable of 18. I mean, for tech stock, right? I mean, look at AMD or Nvidia, and you'll see 50 plus PEs. But this is actually quite decent, especially considering that you have a decent exposure to AI. If we look, for example, a bit lower, Kirill, to the company fundamentals, we can see that their average revenue growth over the past, for however long we have the data, has been growing at 23% on average per year, which is super consistent and double digits and super nice. Net income growth over 30% on average yearly. Let's see. So their long-term debt is slightly covered by their free cash flow, not as insane as we normally see it. And we can also look in when they got that debt and whether or not it makes sense for them. And then the average share buybacks of 0.94%, which is also good to see, of course, given also that they have dividend, is really good for a shareholder. They have a lot of incentive for you to invest in Google.
Yeah, they recently indeed started with the dividend program, which is it's an interesting sign. So it potentially also means that Google probably aims to become something like a cash cow at some point, like let's say Apple. So yeah, got nothing else to add, and it's especially really nice to see that both growth on the top line and the bottom line are exceptionally good over the past 20 years. I think we're talking about 20 years in our overview. So yeah, really good deal. It's only a question of what kind of price we would need to pay, and maybe just look at the interest expenses and the debt, as you mentioned.
So we can see that the interest expenses went up after 2020. So this is probably still some COVID debt being paid off.
Yeah, and they're actually paying it down quite quickly as well since 2022. So they almost, no, well, didn't half it, let's say, but reduced it by, we're talking about 150 million, more or less. And they're doing it quite quickly, so I wouldn't really call it also as a heavy debt burden, especially if we're talking about the revenue of 360 billion, at the most recent point in time. So it's pretty nice. To be honest, everything what I see, I'm pretty happy. Of course, the only downside is the total debt, total liabilities is also growing. As the long-term debt is getting paid off. On the other hand, at least the good thing is that the free cash flow is still able to grow. So maybe the only question would be if it's a justified reason to have an increasing debt burden. That's the thing. If it's a good deal in terms of interest rates on it, sure, don't mind that at all. But yeah, would there be a particular need? Of course, they need to put in a lot of money in R&D. Also, now they recently, well, for a few years already, moved into the hardware market with their phones, with their mobile accessories and stuff like that. So you probably need some liquidity to further that growth.
Exactly. Yeah, the average R&D is at 18 billion. And in 2025, it was 50 billion in R&D. But I can imagine, of course, it's there's a lot of investments coming in from the AI side of thing, and we will end this year at a way higher number than it's currently at. But we already surpassed 2024 when it comes to research and development. But let's go to the ratios, crew. Let's see if it actually how it is in relationship, because I see that, for example, the R&D ratio is still stable. It's the previous years, it's been 25-ish, below 30% at least, which is great. We normally look for companies that are great around, or at least below 40% research and development ratio, mainly because it signals that they have some kind of um, yeah, moat around them. So basically, their brand also does a lot of the work for them in this case. And what you said, Krill, they're going into hardware or lately with the pixels and the buds and whatnot, and of course with AI and cloud computing. But it's still good to see that even though they go into those markets, they're able to keep the research and development ratio stable and manageable.
Yeah, fully agree. And also on top of that, if you think of it in terms of the competition, they're really having a tough environment. So they're competing in the cloud, where you have big competitors in the face of Microsoft. You also have, of course, AWS. Then they are also competing with the giant, like for example, Apple, Samsung on the phone industry, and also the mobile applications and so on and so forth. And they are also now competing on the AI path with Microsoft, with OpenAI, with DeepSeek, and all the other, you name it, kind of competitors. So it's really tough environment that they're in, but they're still able to perform quite well, which really probably speaks for itself, at least when you're looking at the numbers and you're looking at the business side of things. So it's really interesting to see, actually.
Yeah, couldn't agree more. Kirill, is there anything else you want to cover, or should we just dive straight into the valuation?
Yeah, maybe just the last thoughts when it gets to the growth part of things. So it kind of it speaks for itself. So you can see that after 2021, more or less after the COVID peaks, it is going relatively lower to even from the double digits to 5%, 3% on the free cash flow growth, and the revenue growth. We're also talking about 9-14%. It's still a lot for such a giant, but we also need to have certain expectations of it, so that when you become quite big, unless there's some special circumstances, it's really hard to continue the same path as it was in the years prior to that, when it was still like in a growth mode. So something for us to keep in mind, and maybe also to consider in the valuation side.
Yeah, it will be interesting to see how much growth, for example, Yahoo Finance will attribute to our friends at Google. So, Krill, are you ready now?
Sir, yes, sir.
Let's jump into the valuation. So, if this is your first time watching and you have come this far, that's great. We will go we will go through the valuation app together with you, through the calculations, and we'll explain everything we'll do along the way. And of course, if you like what you see, then we will show you at the end of the video where you can access this app for yourself. So let's start, Kirill. We have the free cash flow starting point, and we always use last year. It's the most recent numbers that we have. But of course, if you want to use other numbers, if you have more intel, or if you have your own assumptions about the free cash flow, you can change it to whatever you like. The projection period, basically for how long you would like to have these assumptions last, basically, or for how long you want to hold this particular stock. So, Kirill, Google is such a household name. It has such a diversified portfolio of products. What do you suggest we put as the projection period?
It's an interesting question, because we can again probably just do more or less a realistic scenario, and let's say the worst case scenario and the positive, we can just play around with it. But my suggestion that we can maybe even run it for a longer period of time first, but then put more or less conservative, or like more or less at least realistic estimated growth rate. So for example, we can still do probably 10 years, let's put it like that. It's hard for the whole, let's say, mobile industry to get rid of Android. It's really hard to get rid of Google, especially with the Google workspace applications and stuff. Even we are using it because it's like free, accessible, and it's really user friendly. Now there's Gemini. Maybe we're also going to have more growth opportunities in the cloud business, even further, have more competition with AWS, with Azure. So I think it's rather realistic, actually, that they can, if they're already able to compete on such a high level, let's say, and still be on the winning side rather, at least definitely not on the losing one, I think it's still quite realistic for them.
I agree. Cool. Let's put the 10 years for now then, and then we'll just fiddle with it later. So the discount rate, we keep this at 10%, but whatever you want, and if you, however, you would like to discount the formulas, you can put any number there. For the estimated growth rate, Kirill, if we look at the max, for example, it's rainbows and unicorns and sunshine will be an average of like what 22-ish%,
Yeah.
which would be, I guess, kind of crazy. If we consider the past 5 years, it's looking more realistic of an average of about 6.5-ish%, 5.5%, and the same actually for 3 years. And then we can also check what our friends at Yahoo Finance have to say.
Yeah, it would be really curious to see what kind of thing they come up with.
Yes, and especially we need to consider, of course, that now we have the 10 years projection period, as you said, Kirill. So let's just keep that in mind when we're looking at these analyses. So the growth estimates from Yahoo Finance, they think that this year they will grow by 30%.
Sure.
And next year they will grow by 6%, which is in line with the average that we just discussed. I think for Google for the next 10 years, that might be doable, especially considering how many markets they have and how much they still have to conquer. So let's just put it at maybe 5.5, 6-ish, Kirill. Not sure what your thoughts are on
Let's see. No, I fully agree with you. Let's do 6, and then we can, worst case, for example, reduce the projection period just to be more safe in terms of our expectations. Because, for example, I would be more than comfortable to put, let's say, 6% growth rate for the upcoming 5 years, for instance.
Yep.
The couple of years as well. So.
All right. And then for the PE ratio, I would be confident that we use a lower PE ratio, considering in what life cycle stage they are. It will be good to have something around 18% if we need to adjust for that. We will have to keep this for 10 years.
Yeah, it's true. It's also, of course, we cannot really predict what's going to be in 10 years. Maybe the valuations are going to be even crazier, of course, because I guess we never know. There's going to be faster cycles with more changes coming up. But yeah, of course, we're just speculating in here anyways, and then we can always adjust.
Yep. Yeah, for the required rate of return, we normally put it somewhere above 10% because if you're stock picking, you have a bit much more risk, right? If you would buy an ETF, you would expect somewhere between 7.5% upside year on year on average. But because you're stock picking, you want to have a bit more power, right? You're having a bit more risk, so you need a bit more return. So we normally keep it at 11 or 12%. But if you have like a penny stock or you want to go crazy to check at what rate of returns stock would still be undervalued, for example, you can play around with this as you'd like. And for the margin of safety, this will be dependent on your age and how much you know the industry. If you're younger, you have a bit more risk tolerance, right? Because you're not gambling away your pension, and when you're a bit older, you need to be a bit more careful with your money. So let's say real margin of safety, I think we are pretty confident with Google. We have done about 5-6 videos about them, but also I don't know the whole company by heart, so maybe 20%.
Sure, of course. 220, yeah.
200%.
Why not?
And then we click the analyze button.
And what we have is an interesting range. Again, it's some of these formulas might not be really too much realistic. For example, the Ben Graham's ones is really over pessimistic, I would say. At the moment, when you're considering all of them, we're talking about $120 dollars per share. I can also give you a little bit of an insight. When I was doing my valuation, when I had the Google in my portfolio, I was buying it around 150, which was quite a good price. And then at this point, it's already at 290. even if we consider that the highest assumption here is 300 for the target valuation formula, even with the a little bit of margin of safety and all of that, it's probably either at the fair value on the most, let's say, optimistic view on it. So it would be a little bit hard to think of at what point would it be a better deal. So, okay, if we assume that we can put in 15 years and the estimated growth rate, let's say on the higher side, let's put in, for example, 10, assuming that they're going to do even better. And let's say if they're going to do even better, then we can also assume that they can have a bigger multiple, because if the company is doing better, you're probably paying a little bit more. So like with the Nvidia hype, for example, and so on and so forth. So let's say if we do 25 for the PE ratio. And if we're looking at here, so even on the more positive side, I would say quite not unrealistic, but like really optimistic case, we're talking about, let's say, 210, maybe if we also get rid of the lowest valuation formula result, maybe 220, 230 probably. So I think, of course, Robin, please let me know what you think and share with us. It's probably a little bit too late to jump on it, but that's my take on it.
It of course it depends on how much risk you're willing to take, and how much of a premium you want to pay down, for example, and also which formulas you're comfortable with. For example, Creel, can we open the NPV formula, because this is normally way higher for example, tech companies, but for some reason for this company it's a bit lower, which also interested me.
Yeah, good question. It's really good question. I think it's really also just a question of the growth. So it's either both. We're talking about, there are multiple variables, if you first of all, that you've seen in the formula, but it either needs even higher free cash flow starting point, or the projection period needs to be bigger, or the discount rate needs to be a little bit lower. Yep. So for example, if we're putting in, let's say, 8% in here, let's see how much it's gonna be. Didn't really change. Didn't change at all.
No, but I agree fully with you, Creel. I think if you were Buffett and you bought it somewhere early in Q3, basically where the report is from, you would have a great rally upwards. But especially now with everything that's coming out with Google and all the rallies it has, plus this news dropping, of course, which is pushing the price further. I agree, Creel. I think, for me personally, I think this valuation would be a bit out of my comfort zone if I would jump in without any prior open positions.
Yeah, because you can clearly see if we went down from 200 to 150, already considering the fact that people were thinking about Google being undervalued, it just didn't really have any drivers for growth like AI hype or I don't know, any other particular reason when Google would be like really good, especially back in the days when ChatGPT was really outperforming everyone, all the other models. It was really on a hype train, and Google was like on a catching up side of things. And now since the tables are turning a little bit, Gemini is actually doing quite well. Its additional AI products are also performing quite well. The one with video generating one, for example. And now more and more hype is actually getting into the stock, but it's already at 300. So it already doubled from the lows of March, April. So that's my take, at least.
Yeah. No, I totally agree. And Creel, I always have one final question.
What is it? Tell me. Hit me up.
Where can our lovely viewers get the web app?
Yes, our lovely viewers can go to 930.com. So the link will, as always, be in the description. We're also gonna drop a small hint. We're gonna arrange a giveaway. for the access. That was Generous Robin's idea. So stay tuned as well if you want to learn more. We're probably gonna share the news on our YouTube channel as well, on the LinkedIn and some other sources. But in the meantime, you can check it. It's completely for free. You can make an account. You can just play around, just get a feel of it. It's pretty easy. It's pretty much the same as we were just showing on the videos. And if you would like to also lock the current price for the different tiers, you have to make sure that you do it now, because we're going to be making a new update to the software, and we're also going to be adjusting our pricing tiers as well. So if you would like to stick with the same price, you'd better do it now before it's too late.
Great, thank you, Kirill, and thank you for watching, and we'll see you guys in the next video. Right.